Thank you for joining the GGV IPO Bootcamp. I'm Karen Snow, head of East Coast listings at Nasdaq, and it's my great pleasure to be joined by Jay Heller, Nasdaq's IPO Execution Officer, and Joe Brantuk, Nasdaq's Chief Client Officer, to provide some behind-the-scenes thoughts and advice as you think about accessing the public markets. So, Joe, let's start off with you. Can you shed some light on some of the key things that companies should be doing leading up to their IPO, direct listing, or business combination? And how far in advance should companies start thinking about planning?
Sure. Well, it's a great question, and thanks for the opportunity here. As we think about companies that are considering the public markets, there's sort of the crunch period, which is probably 6 to 8 months before the actual IPO, where you're really heads down in drafting the S1. Working with your law firms, picking the syndicate and your bankers, and that component of it. But I'll first highlight sort of a longer window, if you will. And we say it's generally 14, 18, sometimes even 24 months before an IPO, where you really want to start thinking about operating as a publicly traded company. And that really focuses on, getting your systems and your processes in place, being able to close the books in a timely fashion, thinking about, a lot of the different systematic, processes to put in place that you will need as a publicly traded company. So we like to say that, the most successful IPOs are ones that have been operating like they were a publicly traded company, 16, 18 months prior to accessing the public markets.
Mm-hmm. And what are some of the things that a company should think about in terms of, their bankers, their auditors? What are some of the things that they should be doing to lay that groundwork?
Yeah, so certainly, the selection of, for example, the bankers, right? So there's definitely opportunities to identify teams that know your story and know your space. We think that's really, really important. As we think about, going public, one of the things you really want to consider is your story and the story to the investment community, how you differentiate that story, to the investment community. And your bankers are certainly a strong part of that team that will help you think through that. So certainly that is a component of it. You also mentioned, the law firms. The law firms are also very, very critical because, in addition to working with the exchange and going through the listing qualification standpoint, they're the ones that will really help you think through the other process, which is going and getting the SEC approval, and that is really focused on the drafting of your S1. Working with the commission, and walking through that process. So those are two focus areas for building out the team. And then internally, as we think about a company going public, you want to start thinking about and private companies generally are thinking about their customers or their clients, as a target audience. But as you start to consider a public offering, there becomes a new audience that is important to you, which is the investor audience. And a lot of companies, in my opinion, don't focus enough on this, which is the idea of building out a investor relations program. The investor relations program is really twofold. One, it's the what I like to call the nuts and bolts of the program, which is a lot of the regulatory items, such as having a investor relations website to be able to disclose information in an efficient way, being able to release press releases in a timely fashion. So those are sort of the nuts and bolts of the program. But then on the other side of the program is really about thinking about messaging, thinking about investor targeting, thinking about metrics and way to measure your success of the engagement with the investment community. And that also takes time to build that team. There's two paths to this. Companies have the consideration of appointing someone and hiring someone internally to build out the investor relations programs. But we also see in working with many IPOs, companies outsourcing this and actually bringing on an advisor. And there's some great advisors out there in the investor relations front that will help think through the structuring of the program, the staffing of the program, and many of the buckets that have to be checked in order to have a very, very robust investor relations program leading up to the IPO.
Yeah, that's great advice. And what are some of the key things that a company should be thinking about as it relates to making an exchange decision? And when do you really need to make that decision?
Yeah, well, the exchange decision is certainly a very, very important decision because we like to say the exchanges are with you for the entirety of the publicly traded, entity, whereas, other partners that help you through the IPO, i.e. bankers or lawyers or consultants, they're sort of there as a very transactional, right? They're there to help you get the deal done and then they move on. So that's why the exchange decision is really, really important. And today, when we think about what factors or what criteria go into the exchange decision, we generally boil it down to 4, maybe 5 different buckets of focus. The first one is execution, in terms of the exchange and what exchange is going to be best to execute the IPO from a transaction standpoint, being able to provide your investors an efficient platform to match buyers and sellers, and then also how would the exchange be there to help you really understand the day-to-day trading and the nuances of trading, and really provide that actionable intelligence. So we would put that into the first bucket. The second bucket really is the investor relations piece. At Nasdaq, we're incredibly proud to highlight that over the last 10 to 15 years, we've really been building out a suite of tools that we make available for our listed companies and frankly for all publicly traded companies around the world, as we do sell these services to companies listed on other exchanges as well. And these products and services are really there to help companies, again, build out that investor relations program, and really make sure that they have the right tools and frankly data and intelligence to make sure that they're most effective in the investor relations front. And I like to remind companies that, when you become publicly traded company, essentially you're competing for capital every single day with amongst every other publicly traded company out there. So the best, way that you could really be competitive is to be out there and really be proactive on the investor relations front. So Nasdaq does a wonderful job partnering with our listed companies to provide these tools, these services, these intelligent capabilities, and really empower our companies that are using our tools to have the most effective program. The third bucket, I would say, is where an area that I focus a lot of my time on is how your exchange partner can help you with your branding, marketing, and visibility efforts. So at Nasdaq, we actually spend an incredible amount of time thinking about what types of assets, marketing and visibility assets, we could bring to bear for our listed companies to help celebrate them, help position their brands to the investment community, to customers and potential customers, and really create that awareness of the newly publicly traded company. There's a fourth bucket that individuals should be thinking about, which is the economics of the decision. Certainly, it's an important decision, and one that has a cost associated with it. And so certainly, a lot of companies are thinking about the economics over a long time horizon. So those are 4, and then I would say the fifth one, which is an important one, and we see companies considering this more and more, is really that brand alignment. As we think about the companies that choose and select Nasdaq, there certainly is a brand alignment to Nasdaq's brand, which really represents growth, innovation, disruption, and there's an opportunity there to really celebrate the alignment between us and the listed companies that list with us.
Yeah, I think that's an excellent point. And then the other thing I'd add into that is ESG, right? So as more and more companies are focusing in on that, our services really support companies, but also that brand alignment. I think Nasdaq is really seen as being at the forefront on the ESG side. So Jay, I'm going to switch to you for a second. Let's talk about the different methodologies for going public. And can you frame some of the advantages and disadvantages of the different methodologies?
Absolutely. Well, first, thank you, everybody. It truly is a pleasure to be here today and appreciate the opportunity to educate you on the capital markets. So, Karen, it's a fantastic question. And I would say never before has a company had so many channels and opportunities to evaluate as to what is the right path to being a publicly traded entity on an exchange. And so, historically speaking, there is the typical, initial public offering, or also known as the IPO, where a company transitions from private to public. They're raising capital to further expand for M&A, for general purposes, regardless of the needs of the capital. So that's one. The second being in something that is becoming a lot more relevant in today's capital marketplace is a direct listing. Same premise, company is looking to transition from private to public. They want to use the vehicle, also known as their equity or shareholders, or shares for that matter, as a means to further expand their business, to provide liquidity. But most important, there is not a need for capital today. And so traditional IPO, the need for capital, the direct listing, there is no need for capital. And then you have the emergence of SPACs, which are not new, but they've really come a lot more relevant in the capital market formation and doing a business combination with a SPAC. And this means a company is looking for, I would say, a partner, right? They're looking to find people that can help guide them, those that can join their board, potentially join their management team. But I would say, really important to note, it's about what is the company looking to achieve. There's the benefits of using any means, right? The most important benefit is you're going to be a publicly traded entity. But then it's about what is really right for you. Now, again, from the IPO standpoint, I need capital today. There's what is deemed as, when you raise your capital, the IPO term, the discount. And so people are hiring a consortium of banks to really find the right investors that are willing to invest in you for the short term and, for that matter, the long term. When you go down the path of the direct listing, there is that means of going to be public, going to use my shares for any means that I need in the future, whether it's going to be for expansion, whether it's going to be for M&A, regardless of what it is, and most importantly for liquidity. So it can be derived for early shareholders, it can be for employees, it can be for anybody that has owned those shares for an extended period of time. And then at some point, if the company does need to raise capital, they can always do a secondary offering. And when you're looking at the SPAC and you're looking at the business combination, I would say there's a lot of certainty. And so again, you're choosing the sponsor, you're choosing the shareholders in which you'd like to really become a partner for yours, to join your cap table. And so again, you're telling your story. There's traditional type of IPO investors, but with the SPAC and the business combination, you'll find PIPE investors. We're really subscribing to your story upon completion for an extended period of time. And then you can even go a little bit further. There are companies that are looking to unlock value. And so they may have a core piece of their business that they're trying to really get true valuation. So they may unlock, or they may spin out or carve out a portion of their company, some with a capital raise and some will not. And so again, never before have you had such opportunities to become public. It's a matter of trying to find out by working with your advisors and by working with your partners, I should say as well, to really discuss what is the best path for you when you do choose to transition from private to public.
And can you talk a little bit about the first trade in an IPO and how that might differ from a direct listing?
Sure. Well, again, I would say the biggest difference is the raise of capital. The IPO, you're raising capital. On the direct listing, you're not raising capital. And so I think, stop right there. That's the main difference. But from our standpoint, when a company is deciding to raise capital, it has to be seamless. The execution has to be seamless on our behalf. And so we have spent a tremendous amount of time by thinking of the ecosystem, looking out for the best interest of investors, looking out for our partners, which are the companies that choose to list on Nasdaq. But then I would say the underwriting community, which is extremely important and a very important cog of this ecosystem, because they're the ones that are rounding up the potential shareholders. They're the ones that are on the front lines for the day of your IPO, and they're managing that process in collaboration with the exchange. The uniqueness in Nasdaq, in the way that we perform an IPO and how we collaborate and we execute on an IPO, is truly unique. And the process has been really, I would say, enhanced over the years by just listening to our partners, listening to our companies. What do you expect on day one? What is it about the celebration? What is it about the opening trade? And how do we get that right? The investor community, whether it's retail or institutional, we want all participants to have an equal opportunity to really come to the forum and choose to buy, or for that matter, sell. But I would say really important is the underwriting community, right? You as a company and as you're choosing banks in which you deem the underwriters. You'll hear the term stabilization agent. That is the bank that is officially going to collaborate and lead the premise on executing on your IPO on that day. And so it's our job as the exchange and our job as a partner to really deliver information, to deliver data, really to help mitigate volatility and ensure that an IPO is opened at the right price. And so how do we do it? We do that by creating, and we have created, a technology platform which really brings together not only the communication and the collaboration of all parties, but the data. And so the data in which we deliver, we have now developed a few years back and always looking to enhance this process, where we actually put a desktop on the bank's desk where they can actually see information in a real-time fashion, where we're taking the guesswork out of the equation, where your stabilization agent can actually see where supply and demand comes together. And so it's really enabling that lead bank, that stabilization agent, to understand that if we're going to open an IPO at a certain price point, is that the right price? And so you evaluate on the buy side, are there layers that are very stable? Are there gaps in the book? And on the sell side, if it's a very well received deal, where can I, as an institution, where can I acquire more shares? Or for that matter, are there large sellers or pockets of supply that can cause disruption into the process? And ultimately, that would create volatility once we open the security for trading. And so when you think about you as a company, you're hiring a consortium of banks, you're partnering with an exchange. We feel the way that we deliver this information is modern because we listen to our partners. We gathered their feedback and we built and delivered a system that allows you to take out the intermediary out of the equation, which really means seamless fashion, real-time information, opening a security at the right price, but really being able to bring supply and demand together so that when you do open a security for trading, because the markets are very efficient and deep with liquidity, but you're opening an IPO at the right price and therefore trying to mitigate volatility to the best of your ability.
Yeah, I think the important thing here is there are a couple different prices, right? There's there's where your IPO would price, which happens the night before the stock opens, and then there's an opening price, which is very different. And there's a lot of trading that happens before that opening actually transpires.
Yeah, and I would say this: look, every deal is different, and some are received better than others, and sometimes deals are a little bit challenged. But make no mistake about it: when a company does transition from private to public, and they're raising capital, that is a milestone event. And so we always say that regardless up or down on day one, I'd hate to say it's irrelevant because everybody wants their IPO to go up. But in the fact of the matter is you're now a public entity. And so as you go and as you perform over a period of time, the stock price does take care of itself. But on the flip side, when you're looking at the book, and as we're building the book post-pricing, as you referenced before, which occurs the night before, and you're really leading up to that first official transaction as a publicly traded company, and you're seeing a lot of demand come in, and the security is poised to open at a premium, that's okay if it's sustainable. And so if you priced at 20 and it's going to open at 30 because there's just such an aftermarket demand where people really want to acquire the shares, as long as the buy side demand is very orderly and it's stable. And you can see at every single level that once we open for trading, that there's going to be buyers that are going to be coming into the market, and there's no pockets. So if we priced at 20, we open at 30, and then the next buyer down is at 23, we know that probably 30 is not the right price. But in the same situation where you price at 20 and we're poised to open at 30, but then you look at the layers of buy side demand on the book at 29, 28, 27, 26. Once we open for trading, if a seller does come into the market, it's going to be very orderly. And so again, the way that we provide the information, the way that we provide the data through our technology platform is very unique to Nasdaq. We've truly modernized this process. And again, look, if in that same situation, we priced at 20, we look like we're going to open at 30, but there's gaps on the buy side, and you can't, and you're not accounting for these large sellers that may be selling or be looking to sell, well, maybe 30 is not the right price. So we allow the stabilization agent to really take their time to really ensure that they're opening the security at the right price, but it's the way that we deliver the information, how we collaborate, communicate with them, but then also update the entire trading community. It's a very, very well-defined process where it's an open forum to communicate to ensure best practice on day one.
Yeah, and another thing I want to double click on the direct listing,
Yeah.
You mentioned it might be the right avenue if someone doesn't need to raise capital. But aren't there now ways where you can do a direct listing and simultaneously raise capital?
You can. And so I would say that this is a new rule filing that's in place. We do have the capability to allow a company to potentially raise capital as they do a direct listing. And again, so people would say, well, what's the nuance there? What's different from a direct listing with a capital raise versus an IPO where you're raising capital? And I would say with the IPO, you understand exactly where you're selling your shares and how much capital you're going to raise the night before. With a direct listing with a capital raise, wherever that security opens on day one, that is going to be the official price in which you as a company monetize, and that is going to be the price in which you as a company raise capital at. The other main difference, and again, it's just the differences in the way the process is defined. In an IPO, you have the term stabilization agent, and the bank will step in to stabilize and ultimately support and layer, capital in if there is potential volatility in the market, or for that matter, supply. With a direct listing, even with a direct listing with a capital raise, there is no stabilization agent. So it's almost in effect that the markets will define when will you are open, and then ultimately, as we do open post, the secondary market will dictate where you're going to trade throughout the course of the session. So again, you're right. There's more means to go public. I would say the direct listing with the capital raise is still in the early innings, but make no mistake about it, we're always looking to enhance that process and deliver on something that will be very accessible for companies as a viable option. And I think you'll hear more about that in the future.
So Joe, let's pivot to you. So when Jay's working on opening a stock at Nasdaq, you're often doing sort of the emceeing around the first trade. What is it exactly that you're communicating to management and employees at market site or remotely? And how do you and Jay coordinate on this?
Yeah, it's a great question, and thank you for it. So Jay and I are a very, very tight team. But we are messaging to different people and interacting with different people. So as Jay mentioned, he's interacting and really supporting the syndicate and the market maker community, where I am interacting with the company, the executive team, and frankly, all of their employees. And this is something that has really been a focus of ours, is how do we bring this unique price discovery process to a bigger audience, and frankly to all the employees, as more and more companies look to make this more of an inclusive event, not to sort of keep out their employees, but really to bring them into the celebration, bring them into the process, because frankly, it's on the backs of many of those employees and the hard work of many of those employees that really made and advanced the company to the point where they are able to go public. So we partner very closely with our listed companies, and I'm generally, as Jay is on the phone with the market maker community and the stabilization agent, I'm actually doing a live production or a webcast or a broadcast out to a much larger audience that's internal to the company. So generally, it's their employees, it's their executive team, board members, and so forth. And I'm using this opportunity as an education platform. Frankly, it's not every day that you have that folks are going public. It's once or maybe twice in a lifetime event. So we really take this opportunity to not only educate them about this price discovery process and how the IPO process works and how Jay is interacting with the stabilization agents, but it's also a great opportunity to celebrate the company, celebrate the employees, and really celebrate the brand and in the significant milestones. So Jay and I work very, very closely because one of the components of my talk tracks is where is the stock indicating? And that's really based off of the hard work that Jay and the stabilization agents doing, is trying to figure out where the buyers and sellers are coming and where we're finding harmony in the book, and where the stock would be indicating. And it's that information that I'm sharing out to the community, to really make for an exciting morning.
Yeah, and it's really, I would say, become such a large part of the experience at Nasdaq. So you have a bell, and then you also have this first trade experience where employees can be highlighted, management can address, just different parts of the management team can address employees, and it's really just a fun experience. So you both collaborated recently on Coinbase, which was the largest direct listing ever. Can you talk a little bit about what that experience was like, and what it was like, Jay, to open such a large offering?
Yeah, well, I would just piggyback on what Joe said. It's whether it's the Coinbase direct listing or an IPO, it's always about the experience, and it's such a fantastic event for the company. We're really there to educate and tell them, what's going on. And so when you think about Coinbase, yes, it was the largest direct listing ever. And it was such a unique asset. I mean, it was an exchange living in the land of crypto. There was the premise that the valuations were rising very rapidly in the secondary market. And when you're doing a direct listing, as opposed to an IPO where there's a lot of clarity as to what the security is pricing at the night before. And so you have a good idea as to, you as an investor, where should I look to buy, or for that matter, sell if I own the shares. With a direct listing, you take into all the events, everything that was going on. There's no capital raise. The company is, they're the premise in which they educated the public was done through the Reddit forums, and so all social media. So that was a little bit different than what we've seen in the past. And then you have a brand which is so retail oriented, where people can get really excited about. And so on day one, you're trying to really understand, well, who's going to show up to buy? And for that matter, who's going to show up to sell? And that in itself, really brings to the forefront the technology, because we aggregate this information, we provide it to the financial advisors as they're deemed in a direct listing. But then also, because there's no offering price, the exchange has a responsibility to provide some clarity, to really inform the public what should we as an investor look upon to understand what Coinbase is really worth. And so we have a team at Nasdaq. We have a committee where we spent a lot of time analyzing a lot of data. And so ultimately, the night before, we as an exchange, we would publish a reference price. And so that is just kind of guiding the public as to, if I wanted to buy, for that matter, sell, where should we look upon? Now, again, it's different than the IPO, where the company is actually not raising capital and is not an offering price, but it's just, you're giving a little bit more information. So, the team at Nasdaq spent a lot of time, took in a lot of information, and you're just trying to understand what took place in the secondary market. Was there any liquidity or transactions happening? What's market sentiment? How are peers and how are comps trading? And you really kind of look at all this information to bring it to the forefront to provide one, to create that reference price. But then on day one, it's a long, drawn out, methodical process to ensure that, again, you're opening the security at the right price. And so, it's a case where we really take our time. We really try to over communicate to all market participants. Again, retail, institutional, they all want to participate. So it's ensuring that we open the security at the right price, give everybody an equal opportunity to participate. Because again, with a direct listing, unlike an IPO, there is no allocation. So it's truly based on whoever shows up with the best price is going to buy. And for those that are willing to sell at the lowest price, they're going to sell. And we will sell, simulate an auction throughout the entire process, updating every second, believe it or not, just to provide a lot of transparent data so people are very informed along the way.
Yeah, I think that's super helpful. And I would just add, when you think about the SPAC alternative and the de-SPAC, we tend to lean in there with the same amount of transparency, as well as the ability to celebrate the same way that you would be able to do if it was a direct listing or a traditional IPO. So, being cognizant of time here, I think it would be helpful to share any final words of wisdom or best advice that you would have for a CEO as they're heading into the public markets. Joe, why don't we kick off with you?
Yeah, so certainly it's prepare. And as I mentioned earlier, the most successful IPOs are the ones that have clearly outlined a system and a practice within the organization that really has the mindset of a publicly traded company. Going public is a fun and exciting opportunity, but it's not something you could just flip the switch and you're publicly traded. It's about putting together the right team. It's about thinking about the different audiences that are your new audiences that you're going to be targeting, and then making sure that it's that team, the team approach. And then again, from my perspective, it's the companies that really look to partner, with the exchange and with Nasdaq are the ones that we tend to have the most fun with, right? So really recognizing this not only as a financial transaction, which certainly an IPO is, but it's also a great branding opportunity, and don't lose sight of that. And the exchanges could certainly help you, and Nasdaq could certainly help you, better think through, how you maximize the moment from a PR perspective, from a social perspective, from a client acquisition perspective, from a reputation perspective, and then also never lose sight of the employees, and how we could really integrate them. So it's a lot of fun, and that's what I would point to. There's a lot of boxes that have to be checked, but the sooner you could start the process, the better.
Yeah, and I would just say, as a company, just take the time from an execution standpoint to understand what is the right premise for you, whether it's going to be an IPO, a direct listing, or doing a business combination with a SPAC. You're leading up and taking all this time to get to the finish line and to transition from private to public. So take the time, find the right partners on the exchange standpoint, on the underwriting or financial advisor standpoint, understand the structures that are accessible to you, and ultimately choose the path that works best. And from we as an exchange, we have no preference. We're looking at a partner and really use everything in our toolbox, really help amplify your message, help you succeed in the future, and just be a long-term partner.
That's great. Thank you. So that's it for our IPO bootcamp. Please feel free to reach out to any one of us if you'd like to do a deeper dive, and we look forward to supporting you as you think about entering the public markets.